Welcome to this session dedicated to the analysis and interpretation of corporate management. This is a fundamental field for anyone working in economics and finance. A thorough understanding of a company's health and performance is crucial to its success. The analysis and interpretation of corporate management are crucial processes for understanding a company's financial health. Through these methodologies, we can objectively evaluate past and current performance. Their primary purpose is to provide a solid basis for future decisions. This analysis is based on an in depth examination of a company's accounting and financial data. This often complex and extensive data is transformed into useful and meaningful information. It is a process that requires rigor and a structured methodology. The ultimate goal of any management analysis is to support informed strategic decisions. Whether it's investment, operational planning, or evaluating new opportunities, a clear understanding of the company's situation is essential. This allows you to mitigate risks and maximize growth potential. The core of this analytical process lies in the reclassification of the balance sheet and income statement. This preliminary phase is a fundamental and essential step. It prepares the raw data for subsequent analysis, making it more readable and comparable. Without proper reclassification, subsequent analyses may be distorted or incomplete. Reclassification is the first methodological step in transforming accounting data into effective analytical tools. It goes beyond simply reading financial statements. It allows us to extract the true economic meaning of accounting entries. Reclassification involves reorganizing the original accounting data presented in financial statements. The goal is to present this information in a more analytical and functional format. This process makes the data more suitable for financial and management analysis. The primary objective of the balance sheet reclassification is to highlight the company's financial structure. A distinction is made between current and non-current assets, classifying investments based on their liquidity. Similarly, current and non-current liabilities are distinguished, categorizing sources of financing based on their collectibility. Finally, shareholders' equity, which represents the portion of capital owned by shareholders, is highlighted. This distinction is crucial for assessing financial stability and capital strength. The reclassification of the income statement aims to present a company's profitability more transparently. Revenues are highlighted, representing the value of sales and services provided. Operating costs are then analyzed, distinguishing between variable and fixed costs, or between production costs and overhead costs. This leads to the presentation of operating profits, which indicate the profitability of core operations. Finally, net profit is presented, which is the final result after taxes and financial expenses. This structure allows for a better understanding of income generation. The benefits of reclassification are numerous and significant. It facilitates the identification of historical and prospective trends in company performance. It also allows for a clearer identification of the company's strengths, such as a solid capital structure or high operating profitability. At the same time, it helps identify weaknesses such as excessive debt or low margins. Once the financial statements have been reclassified, the next step is to apply ratio analysis. This methodology transforms accounting data into powerful, concise indicators. Ratios allow performance to be compared over time and with that of other companies. Financial ratio analysis is based on examining data reclassified using specific ratios. These ratios are calculated as the ratios between different balance sheet items. They offer a quantitative perspective on the company's financial and operational health. The primary function of ratios is to provide a concise and immediate view of company performance. They condense large amounts of information into a few key figures. This facilitates understanding and interpretation of the economic and financial situation. Among the most important ratios, profitability ratios are crucial for assessing a company's ability to generate profits. They measure the efficiency with which a company uses its resources. ROE, or return on equity, measures the profitability of equity. This ratio indicates the net profit generated for every euro invested by shareholders. It is a crucial indicator for shareholders as it directly reflects the return on their investment. A high ROE suggests efficient management of the owner's capital. ROE is calculated by dividing net income by shareholders' equity. It's important to analyze ROE in relation to the industry and overall economic conditions. A sustainable ROE is a sign of solid and profitable management. ROI, or return on investment, measures the profitability of overall invested capital. This ratio evaluates the efficiency of using all company resources, both internal and external. ROI is an indicator of a company's ability to generate revenue from its operating activities. ROI is calculated by dividing operating income by invested capital. A high ROI indicates that the company is generating a good return on its investments. It is useful for comparing the performance of different business units or projects. A ROS, or return on sales, measures sales profitability. This ratio indicates the percentage of operating profit generated for every euro of revenue. ROS is an indicator of operational efficiency and the company's ability to control costs. ROS is calculated by dividing operating income by sales revenue. A high ROS suggests that the company has a good profit margin on its sales. It is particularly useful for comparing performance among companies in the same industry. In addition to profitability ratios, there are other categories of ratios that are equally crucial for a complete analysis. Solidity ratios assess a company's ability to service its long-term debt. They measure the capital structure and level of debt. A solid company is able to sustain its liabilities without compromising its ability to continue operating. Liquidity ratios, on the other hand, assess a company's ability to maintain short-term financial stability. They measure the ability to meet immediate financial commitments. Adequate liquidity is essential for day-to-day operations and to avoid cash crunches. Cash flow analysis through the cash flow statement is an essential and often overlooked component of management analysis. It offers a unique perspective on a company's financial dynamics. While the income statement and balance sheet provide a snapshot, the cash flow statement shows the movement. The importance of the cash flow statement lies in its ability to examine actual cash movements. This document is essential for understanding a company's true ability to generate liquidity. Cash is the lifeblood of every business, and its management is critical. The cash flow statement is an accounting document that provides a detailed overview of cash flows. It records all incoming and outgoing cash movements. These movements refer to a specific period, usually a quarter or a year. The cash flow statement is divided into operating, investing, and financing activities. To fully understand the financial statement, it's crucial to distinguish between the accrual basis of accounting and the cash basis of accounting. This distinction is the basis of many financial misunderstandings. The accrual basis of accounting requires the recognition of revenues and expenses when they occur. This occurs regardless of the time of actual collection or payment. For example, a credit sale is recorded as revenue even if the money has not yet been received. This principle offers a more accurate view of financial performance over the period. The concept of cash, on the other hand, refers to actual cash flows. It records only transactions that involve an actual movement of money. A receipt from a customer or a payment to a supplier are examples of cash flows. The cash flow statement focuses exclusively on these actual movements. The usefulness of the cash flow statement is many and profound. It helps understand how a company generates cash from its main operations. It also clarifies how the company uses cash for investments or to repay debt. It provides crucial information on the ability to finance day-to-day operations without resorting to external financing. Likewise, it offers insights into the ability to finance strategic investments for future growth. A careful analysis of the cash flow statement can reveal liquidity problems even in seemingly profitable companies. In short, analyzing and interpreting business management are complex but essential processes. They require a methodical approach and a thorough understanding of various disciplines. Their correct application is key to effective business management and winning strategic decisions. Management analysis and interpretation are intrinsically complex and multidimensional processes. It's not a simple matter of reading numbers, but an art that combines science and intuition. They require a holistic view of the company and its context. To conduct an effective analysis, two fundamental elements are required. First, a solid understanding of accounting principles and financial reporting regulations. Second, a thorough understanding of business dynamics and the industry in which the company operates. By reclassifying balance sheets, analyzing ratios, and examining cash flows, it is possible to obtain a comprehensive and detailed overview. This overview encompasses the company's financial health, profitability, and ability to generate cash. Only in this way can truly informed and strategic decisions be made.